Welcome back to Econverse. Today, we're diving into something that honestly feels ripped from the headlines. Artificial intelligence and its potential impact on global economics, even financial crises.
It's a hot topic for sure. You've probably heard about AI taking over jobs. But what we're really digging into today is its potential to both predict and possibly even prevent economic turmoil, but also the risks that it could bring to the table.
Yeah, this isn't some far-off sci-fi scenario. AI is already being used in finance right now. To really get this, we've analyzed research and reports from the World Economic Forum, the IMF, even some cutting-edge work from universities.
Yeah. What we found is fascinating. There's serious potential for positive change, but also some very real concerns that we can't ignore. For our listeners out there, whether you're a seasoned investor or just trying to understand your 401k, this stuff matters.
All right, let's get into it. First up, the big question. Can AI actually predict financial crises before they happen?
There's definitely research pointing in that direction. Imagine early warning systems that crunch massive amounts of data, way beyond human capacity, to spot those subtle signals of an impending crisis.
So like having an economic crystal ball. How would that even work in practice?
Well, think about it this way. Certain algorithms can analyze patterns in historical data, like past crises, to learn the warning signs. The University of Liechtenstein is already doing this with banking crises, and their early results are pretty promising.
So they're basically teaching AI to recognize the early symptoms of a financial meltdown. That's wild. But what about those unpredictable events, the so-called black swan events that seem to come out of nowhere? Can AI handle those?
Predicting those is still a huge challenge, even for the most advanced AI. However, when it comes to more frequent economic downturns, AI is getting much better at recognizing the patterns that precede them.
Okay, so AI might not be able to predict every economic hiccup, but it could give us a heads up on those more common recessions. That's still pretty huge.
Absolutely. And it's not just one method they're using. There's supervised learning, like we just discussed, but also unsupervised learning.
Unsupervised learning, what's that all about?
Think of it like this. Instead of giving AI labeled data and telling it what to look for, we let it loose on mountains of data to find connections that we might miss.
So it's like letting AI explore a massive financial library and see what it uncovers.
Exactly. It might find a correlation between, say, social media sentiment and stock market fluctuations, something we wouldn't even think to look for.
That's fascinating. But it makes me wonder, if AI is so powerful, why didn't it prevent the 2008 financial crisis? We had computers back then, right?
That's a great question. Back then, the algorithms weren't as sophisticated, and perhaps even more importantly, we didn't have the sheer volume of data needed to train AI effectively on those massive, complex events.
So it's not just about the AI itself, but also the data we feed it.
Absolutely. The quality and quantity of data are crucial for AI to learn and make accurate predictions.
This all sounds amazing, but I can't help but think, are there any downsides? It almost feels too good to be true.
You're right to be cautious. While the potential is huge, there are some valid concerns. For example, what experts call the black box problem. Basically, we don't always understand how AI reaches its conclusions. Imagine AI suddenly deciding to dump stocks, triggering a panic without anyone really understanding why. That lack of transparency can be a real issue in a system as complex and sensitive as the financial market.
It seems like AI could bring a whole new set of risks to the table, stuff we haven't even thought of yet.
That's right. Another concern is the potential for flash crashes, rapid market plunges driven by AI trading algorithms that can happen too fast for human intervention. And then there's the issue of data bias. AI learns from historical data, so if that data is flawed or biased in some way, the AI's decisions will be too. It's like we're building a superpowered engine, but we don't have the instruction manual.
And we're putting it in charge of our global economy. So we need to be super careful how we develop and use AI in this context.
Exactly. And there are some truly chilling possibilities to consider, what some call an AI crisis, where AI itself triggers a financial meltdown.
That sounds terrifying. How could that even happen?
Well, the IMF has actually issued warnings about this. Their research suggests that AI could lead to widespread job displacement, especially during a downturn. This could overwhelm social safety nets and create a ripple effect throughout the entire economy.
So it's not just about rogue algorithms making bad trades. It's about the larger economic and social impacts of AI-driven automation.
Precisely. Imagine a scenario where AI-powered funds all panic at once or global supply chains grind to a halt due to faulty AI predictions. It's a recipe for global meltdown.
Okay, that's pretty bleak. But surely there are things that we can do to prevent this. We're not just sitting ducks here, are we?
Not at all. We have the power to shape how AI develops and influences our economy. One crucial step is rethinking our tax systems. Many current policies favor automation over human jobs, and that needs to change.
So we've talked about the risks, but let's shift gears a bit. Can you give us a concrete example of how AI is being used right now to address financial risks?
One fascinating example is the European Banking Authority, or EBA. They're using AI to monitor banks for signs of financial distress, analyzing huge amounts of data instead of relying on traditional manual inspections.
So instead of having human analysts pore over spreadsheets, they've got AI looking for red flags.
Exactly. It's a powerful example of how AI can be used proactively to identify and mitigate risks within the financial system.
Okay, that's encouraging. But wouldn't this create a sort of feedback loop where the actions AI takes to mitigate risk then influence its future predictions?
That's a very insightful point. It highlights one of the big challenges with AI in finance, the potential for unintended consequences. The more we rely on AI to manage our economy, the more we need to understand how its actions ripple through the system, sometimes in unexpected ways.
So far, we've focused on short-term risks and mitigation. But what about the long-term impact of AI on the financial landscape?
That's where things get even more interesting. One thing that's puzzled researchers is why AI seems to be better at short-term predictions than long-term ones. You'd think with all its data crunching power, it could see years, even decades into the future.
Right. Why is it so good at spotting the next recession, but struggles to predict the next big economic paradigm shift?
Well, it turns out long-term forecasting is a different beast altogether. It's not just about analyzing mountains of data. It's about understanding those more nuanced, harder to quantify factors: geopolitics, social trends, even human psychology.
Ah. So AI might be great at spotting patterns in data, but it's not so good at predicting how those messy, unpredictable humans will behave and throw a wrench in the works.
Exactly. Long-term predictions often hinge on those human elements, and AI, for all its sophistication, still struggles to grasp that level of complexity, at least for now.
Okay, so maybe humans aren't obsolete just yet. We still have a role to play in those big picture economic decisions. But what about the people who work in finance? How is AI impacting their jobs on a day-to-day basis?
That's a question with some potentially unsettling answers. AI is already transforming the asset management industry, and the reality is not everyone will benefit from these changes.
So are we talking about AI taking over jobs in finance, just like we're seeing in other industries?
It's already happening. Think of those traditional fund managers, the ones who've relied on their gut instincts and years of experience to make investment decisions. They're finding themselves increasingly outmatched by the quants.
Quants. Is that what they're calling those data scientists who build all the fancy algorithms?
Exactly. The quants are becoming the rock stars of finance because they're the ones who can leverage AI to analyze vast amounts of data and spot those subtle market signals that humans might miss.
So is this the end of the line for those old school fund managers? Are we going to see robots running Wall Street?
Well, it's not quite that dramatic, but the skills needed to succeed in finance are definitely changing. Those who can adapt and embrace AI are likely to thrive, while those who cling to traditional methods might find themselves struggling to keep up.
It's kind of like the Industrial Revolution all over again, but instead of machines replacing physical labor, it's AI taking over those cognitive tasks. Are there any specific examples of how it's being used to try and create a more equitable economic system?
There are some promising initiatives out there. For example, the AI Economist Project is using machine learning to design economic policies that try to strike a balance between efficiency and fairness.
So using AI to figure out how to create a more just and equitable economic system. That's incredible.
It's still in its early stages, but it's an inspiring example of how AI can be used to tackle those big systemic challenges.
That's definitely a hopeful sign. But let's go back to those potential risks for a moment. We've talked about flash crashes, but are there other ways AI could destabilize the financial markets?
One concern is the potential for algorithmic collusion.
Algorithmic collusion, what's that?
It's the idea that AI systems, even without being explicitly programmed to do so, could end up coordinating their actions in a way that harms competition.
So like a bunch of AI traders secretly working together to manipulate the market.
Essentially, yes. And because these algorithms can be incredibly complex, it could be extremely difficult to detect or prevent this kind of behavior. Another concern is what some experts call market fragility. The more interconnected these AI trading systems become, the greater the risk that a failure in one system could trigger a cascade of failures across the entire market.
Like a domino effect where one AI's bad decision sets off a chain reaction that brings down the whole system.
Exactly. And because these AI systems operate at lightning speed, it could happen so fast that human intervention wouldn't be possible.
This is starting to sound like a financial horror movie. Are there any ways to prevent these kinds of catastrophic scenarios?
One crucial step is to ensure that these AI systems are transparent and auditable. We need to be able to understand how they're making decisions and hold them accountable when things go wrong.
So more regulation and oversight of AI in finance.
Absolutely. We need clear guidelines, robust testing procedures, and maybe even some kind of kill switch that could be used to shut down these systems in an emergency.
It sounds like a lot of work still needs to be done to ensure that AI is used responsibly in the financial world.
It does, and this isn't just a job for regulators and policymakers. Everyone involved in the financial industry, from the developers of these AI systems to the investors who use them, needs to be aware of the potential risks and work together to mitigate them.
So it's a shared responsibility.
Absolutely. The future of finance is inextricably linked to AI, but we need to approach this technology with caution, foresight, and a commitment to ethical development and use.
Okay, we've covered a lot of ground here. The good, the bad, and the potentially catastrophic. But before we wrap up, I want to circle back to the idea of preventing financial crises. Is AI really the silver bullet we've been hoping for?
AI undoubtedly has the potential to revolutionize how we manage risk and predict economic downturns, but it's not a magical solution that will eliminate all financial crises.
So AI can help, but it's not a guarantee.
Exactly. We still need sound economic policies, responsible financial regulation, and importantly, human judgment to navigate the complexities of the global economy.
It seems like a balanced approach is key, embracing the potential of AI while also acknowledging its limitations and taking steps to manage the risks.
And that's where it becomes less about the tech itself and more about our choices. We need to consider not just the potential benefits of AI, but also the ethical implications, the potential for job displacement, and how those gains are distributed.
So almost like we need a whole new economic philosophy for the age of AI.
We might. And institutions like the World Economic Forum and the IMF, they're taking this seriously. They're bringing together experts to discuss these challenges and try to figure out solutions.
Yeah.
We have the knowledge, we have the tools, and we definitely have the resources to navigate this transition. But it's going to require collaboration, innovation, and a willingness to adapt.
Well, this deep dive has been quite the journey. I started out really excited about AI's potential, then got honestly pretty scared by some of the risks, and now I'm feeling, well, I think cautiously optimistic.
That's a pretty common reaction to this topic, to be honest. It's such a complex and rapidly evolving field, and there's still so much we just don't know. But the more we learn about AI and its potential impact, the better equipped we'll be to make the right choices. That AI is a powerful tool, but it's not a cure-all. It's up to us to use it wisely and responsibly to create a more stable, equitable, and prosperous future. The choices we make today, they're really going to determine what that future looks like.
Well said. And on that note, we've reached the end of our deep dives into AI and financial crises. To all of you listening out there, thanks for joining us on this exploration. We hope this episode has shed at least a little light on this complex and fascinating world of AI and its potential to reshape the global economy.
And don't forget to check out the show notes for links to all the sources we discussed today.
And as always, let us know what you think on social media. We love hearing your thoughts and perspectives.
Until next time, stay curious, stay informed, and stay engaged. The future is in our hands.
From all of us here at Econverse, thanks for listening.